Every laundering case that ever gets solved starts the same way. Not with a raid, not with a wiretap, with a number that didn't add up, sitting quietly in a database waiting for someone to notice it. Here are the 10 levels investigators actually work through to unwind dirty money, from a duffel bag of cash to a scandal that takes down a bank. Level 1, the cash deposit. Someone walks into a bank with a pile of cash that adds up to something suspicious. US law requires banks to file a currency transaction report on any cash deposit over $10,000. Automatic, no suspicion needed, so the amateur move is splitting deposits. $9,900 here, $9,800 there, across different branches, different days. It's called structuring, and it's itself a federal crime, completely separate from the money's origin. Here's what makes it the easiest level to catch. Banks aren't just watching for deposits over the threshold, they're watching for deposits clustered just under it. Compliance software at most major banks flags this automatically, comparing timing and amounts across branches in ways no employee ever could. A 2025 regulatory update clarified banks don't need to file on every near-threshold transaction, only when there's real reason to suspect evasion, which actually makes the pattern matter more, not less. Level 2, the cash business. Once the money's in an account, it's nowhere close to clean. So the next move is a business that already deals in cash. A laundromat, a car wash, a vending route. Mix dirty cash in with legitimate earnings before it touches a bank record. A laundromat genuinely brings in $4,000 a month, you report $6,000. And the extra $2,000 rides along disguised as revenue. This caps out fast. You can only launder roughly what the business could plausibly have earned. And investigators check something most people never think to flip around. How much water or detergent a laundromat actually buys relative to what it claims to wash. A business claiming $6,000 in laundry revenue but buying supplies that would barely cover half that is exactly the mismatch that turns a routine audit into something bigger. Level 3, shell companies and fake invoices. Once a single cash business can't absorb enough volume, the method shifts to companies with no real customers. A shell company exists on paper, sometimes with an address that's just a mailbox service, generating invoices for services never performed. A shell builds a real business for consulting. The real business pays. Money moves from an entity that has to explain its income to one that never has to prove it did any work. One fake invoice looks ordinary. 20 of them moving through 6 shell companies across 3 states start looking exactly like what they are, but only if an investigator sees all 20 at once, which is why investigators usually start with the registered agents, not the invoices. A dozen unrelated looking companies sharing the same mailbox service or accountant is a structural fingerprint that survives even when every invoice looks clean alone. Level 4, real estate. Property values are subjective, and subjective valuation is exactly the gap dirty money slides through. Buy a rundown property for $200,000, partially in structured cash. A year later, sell it to a shell company you control for $500,000. A price nobody can definitively disprove. The $300,000 difference is now clean profit on paper. This scales beautifully across cities and shell buyers without ever tripping the cash deposit flags that catch people stuck at level 1. The uncomfortable detail, in many places, real estate agents and title companies have historically faced far lighter anti-laundering obligations than banks handling the same size transaction. Regulators in several countries have started closing that gap specifically because real estate had become the visible weak point relative to how tightly banks were already being watched. Level 5, offshore structures. Domestic laundering hits a ceiling because domestic institutions eventually share information with each other. The offshore method depends on jurisdictions chosen specifically for weak ownership disclosure. Places where you can register a company without the public record ever showing who owns it. Money moves into an account held by a shell owned by a trust administered by a local agent with no real ability to identify who's actually behind it. Layering means routing money through multiple offshore jurisdictions in sequence, each hop requiring a country to individually agree to share information before investigators can see the whole chain. Some cooperate quickly, others take years if they release records at all. International automatic information exchange agreements between tax authorities have expanded significantly in the past decade specifically to close this gap, but coverage still varies enormously by jurisdiction. Major leaked document sets from offshore providers, published through international journalism over the past decade, exposed just how routine this infrastructure had become. Thousands of shell companies process through the same handful of formation agents using nearly identical paperwork templates, serving everyone from ordinary tax avoiders to serious criminal networks. Level 6, trade-based laundering. Regulators consistently call this the hardest method to detect because it hides inside ordinary international commerce. A company ships goods with a plausible but hard to verify value and invoices it for far more than it's worth. The importer pays, and the gap between real and invoice value is now dirty money that's crossed a border disguised as a trade payment. Under-invoicing works in reverse, shipping genuinely valuable goods but invoicing them for a fraction of their worth, letting the receiving side resell at full price and pocket the difference as legitimate sales revenue. Both exploit the same weakness. Customs agencies exist to catch smuggling and tariff evasion, not to independently verify whether an invoice price for a container of furniture is reasonable. Detecting it usually depends on trade analytics comparing declared prices against a huge database of what similar shipments typically sell for. A single unusual invoice proves nothing alone. Legitimate businesses genuinely pay strange prices sometimes, but a company repeatedly pricing shipments at the extreme edge of plausibility across dozens of transactions over years is exactly the statistical pattern that eventually draws a fraud unit's attention, even when any single shipment passed unnoticed on its own. Level 7, cryptocurrency mixing. Here, the method shifts to exploiting a financial system still catching up to the technology. Mixing services pull cryptocurrency from many sources and redistribute it, breaking the link between a specific deposit and withdrawal on the public blockchain. Dirty crypto goes in, an equivalent amount mixed with everyone else's comes out to a new wallet with no direct link to where it started. The blockchain is both the tool that enables this and the reason it eventually fails for people relying on it. Every transaction is permanently recorded, which means investigators can sometimes trace funds by analyzing timing and clustering across the entire pool. Several major mixing services have been seized precisely because their own transaction logs, once obtained, retroactively unmixed years of transactions at once. The anonymity promise turned out to be temporary, lasting only until the service itself became the target. Level 8, correspondent banking. At the largest scale, individual transactions barely matter, because laundering happens inside the relationships banks maintain to move money internationally. A bank in one country processes transactions for a bank in another with no direct relationship to the ultimate destination. This system is essential for legitimate finance and has also been exploited in some of history's largest documented laundering cases, where a bank willing to look away processed billions in suspicious transactions for years before anyone caught it. These cases usually unravel only when an insider comes forward or a compliance review notices volume that doesn't match a client's actual business. The failures are typically more mundane than people expect. An under-resourced compliance team drowning in alerts, a bonus structure rewarding volume over flagging, a relationship considered too profitable to properly scrutinize until outside pressure forces the issue. Level 9, the people who actually crack it open. Behind almost every major laundering prosecution, there's a person, not just a paper trail, an accountant who kept records they weren't supposed to, an employee who decides compliance needs to see something, a registered agent who finally talks after years of quiet unease. Many jurisdictions now offer substantial financial rewards to whistleblowers whose reports lead to prosecutions, built specifically because internal cooperation cracks open what external investigation often can't reach. Every method on this list can survive years of external scrutiny. Almost none survive a single insider who's done staying quiet. Level 10, how it actually unravels. Every level, from a duffel bag of cash to a correspondent banking relationship, moving billions, depends on the same vulnerability. Money has to explain itself at some point, to some institution, in some jurisdiction, and every explanation becomes a data point that outlives the transaction. Financial intelligence units like FinCEN exist specifically to aggregate suspicious activity reports and cross-border data into patterns no single bank or country could see alone. A shell company invoice looks unremarkable alone. That same invoice, cross-referenced against 40 others flagged across different countries over several years, starts to reveal a structure that was always there. Most major prosecutions take years for exactly this reason. What eventually convicts the people running these operations is never one transaction. It's the slow accumulation of every transaction across every level, finally showing the thing dirty money was always trying hardest to hide. A straight line connecting exactly where it started to exactly where it ended. If this changed how you think about where dirty money actually goes, drop the level that surprised you most in the comments.